This has never happened before with the yield curve. Also, could the interest rates be giving us an indication of when the big crash is going to come? Well, I'll share that information with you in today's video. Before we dive into those super important topics, make sure to smash on the thumbs up button. If you do enjoy this kind of content, obviously, subscribe to the channel if you're new around here so that the YouTube algorithm is going to feed you some more of these great videos in the future. Let's get it. So, I want to start off with the thing that has never happened before. Well, very interesting. Two things, actually. This is the longest ever yield curve inversion. Now, the yield curve inverting is the signal that basically always means a recession is going to come afterwards. So that's the 10-year minus the 3-month Treasury yield has been inverted now for 216 days, the longest period of time in history. It's never happened before. We are in unprecedented times for the markets. The question that a lot of people are asking is, well, what the heck does that mean? And to be honest, nobody really knows. Speculations range from, well, this could mean that actually the soft landing narrative could be coming. The Fed is actually fixing the problem and things might be okay. Or if there is a recession, it's going to be a short, shallow one. Opposite views, obviously, are that this is an indicator that the new Great Depression is coming. It's going to be worse than anybody could possibly imagine. 2008 was just a practice round for the pain and suffering, gnashing of teeth, and pulling of hair that is about to come. Who's right? Well, we don't know. We'll find out, of course, eventually. But it's definitely a fascinating thing to see that we're breaking records, living through history, guys. Congratulations. Also, this one, very, very interesting. The last 4 times the yield curve inverted, we saw, of course, the 1990 recession, the dot-com bubble, the global financial crisis, 2020 recession, and today we are more inverted than all of those. So this is the first time this century, definitely, that we've seen such a wild yield curve inversion. More great records to be making. Pretty crazy stuff, though. Is this time different? Well, as we know, saying this time is different, as John Templeton says, the 4 most dangerous words in investing. This time may not be different, but if this time is not different, well, then how is this time going to be the same? And that's something that's interesting regarding the Federal Reserve interest rate hikes. But more on that momentarily. I want to share this one with you here as well. History may not repeat, but it does often rhyme. Every U.S. recession since 1955 has been preceded by a yield curve inversion. According to Jesse here, he says, with that being said, this doesn't look, feel, or smell like an economy teetering on the brink. Will this time be different? Who knows? It's interesting. The economy has remained quite strong. Stock market's been doing okay, although we can see these rallies come before a mega recession comes in. It's happened before. It could happen again. Unemployment rate has gone up recently a little bit, but not dramatically yet. And a lot of the effects of this potential recession may not be felt for a while because of the lag effect. More on that momentarily, of course, as we dive into the Federal Reserve interest rate conversation portion of this video. Joe here pointing out the yield curve is re-steepening at breakneck speed. So you can see right here, we are seeing, after a big decline, the yield curve starting to come back up. It's up by 10 basis points or more today across the curve. Do you know what happens when the yield curve steepens every single time? Recessions. That's what happens. Very interesting data point to see here. For example, if we look back to the 2008 crash, when we saw the yield curve moving back up, it was shortly followed by the 2008 crash, but that started like in 2006. So it took a few years. It didn't happen immediately. No, didn't happen immediately. Now, the whole 2020 thing was a bit more of an accelerated one-off event because of the nature of the pandemic. Let's go back to a different conversation, a little bit earlier back here. Let's go back to 2000. So 2000, we saw the yield curve turning back up, and it was quite quickly followed by a big recession, partially, of course, due to the acceleration of stock market uncertainty following 9/11. Usually, though, it does take a little longer without a crisis. If you look back to the early 90s, when we saw the yield curve finally starting to reverse, it took a few years for the recession to actually set in. Again, there's a big lag most of the time if there's not a crisis. If there's a crisis, things move much, much quicker, as in 2020, for example. When there's not a crisis, it can take a little while. Also, this chart may not be the clearest one, but it's quite interesting, shared by Peru. He says, history may not repeat, but it often rhymes. There that is again. Over the past 70 years, all post-yield curve inversion stock market rallies fully reversed going into a downturn. So the red line on the chart here shows our current rally, and all the other lines show all the other post-yield curve inversion stock market situations where we did have markets push higher and then blammo, down dramatically. Now, before we get into the Federal Reserve, the lag effect, all this very important information, I did want to do a quick mention of the Wealth Mastery newsletter. If you are a cryptocurrency investor, you want to learn more about the cryptocurrency market, you want to stay up to date on the latest alpha in the cryptocurrency market, this is the newsletter for you. We have created this newsletter specifically for people who want to learn more about crypto, who want to stay up to date with the latest happening in the industry. Me and my team, we spend about 40 hours a week writing this bad boy, and you can get it for free in your inbox and join our 75,000 weekly readers by clicking on the link down below in the description. You'll get the latest news, altcoin alpha, DeFi alpha, airdrop alpha, technical analysis, and much, much more. So check it out using that link in the description. Thank you very much. Now, this is a super interesting chart. When interest rates peak, recessions tend to lag anywhere from 6 to 17 months behind. This is very important. This is the when we may see a recession question. Rate cuts usually come just a few months before the recessions start. So basically when rates peak, most of the time, that starts the clock. How long until the recession comes? Assuming we get one more hike in 2023, which is kind of what the Federal Reserve is currently telegraphing, could be a hike next month or something like that. We'll see when it comes out, if they do one. But generally, the market is expecting that there will be one more rate hike. But assuming we get one more, then set a clock for, well, about a year before a final top for the market, before the proverbial crap hits the fan. So you can see in 2006, it took 17 months. And let's zoom in on that, because I think 2006, 2008, it's a very interesting comparison here. Because, you know, if you look at what happened, for example, in 2019, it's not the best example because we had the pandemic, which was kind of an unexpected event. So 2006, 2007, 2008, much better example. So here we go. July 2006, the Federal Reserve stops raising interest rates. Now, what happened from that point? The S&P 500 rallied almost 30% higher. That's from July 2006 until November 2007. So we had almost 18 months of a market rally before shit started hitting the fan. Now, what was the indicator that things were about to get bad? The rate cuts. So they kept rates flat from July 2006 until July 2007 for a year. That's about the current estimate of what the Fed's going to be doing now. They might have one more interest rate hike and then keep rates higher for longer. So basically for a year, during which time we could see a major market rally, the final blow off top before things get really, really bad. This is just, of course, my thoughts, a prediction. I don't know what's going to happen in the future. Nobody does. We just look at charts and try to speculate on what could happen. But you can see here, in July, we had the first rate cuts. And then by November, just a few short months later, that's when things really started going wrong in the markets. Now you had basically from November to about May, so you had a 4 to 6 month window to get out completely from the markets before markets suffered a huge collapse. So if you take it from the final rally before things really went to crap, you could have got out before a 54% collapse the markets came. Of course, peak to trough, we saw a 57% decline in the market. So you had 6 months still to exit the market from the time that markets started turning around, and you had about 8 or 9 months to get out of the market from the time that the interest rates started being cut. Now, a recession was announced right around in here. So the markets bottomed during the recession, not before the recession, during the recession. So if you think about where we are right now, we still could have one rate hike to come. In fact, this is the Fed rate monitor tool. Right now, there's a 68% chance that at the November 1st meeting, the rates are going to stay unchanged. So 31.5% chance that we're going to see an interest rate hike. The Fed has said they are foreseeing, or at least a 2/3 majority of the Federal Reserve Board is saying that they see another interest rate hike coming. So we'll keep an eye on that. And if you start looking farther down, we see higher chances of one more rate hike in December at 39%. January, almost 40%, and then you start getting too far out to even really consider any of that being valid information. Next few months is probably most important to see. Because again, once that final interest rate hike comes in, then we go flat for maybe about a year. That is the time when we could see the final rally in the market. That is the time when things start to get real dangerous, especially after about a year. If there is going to be a big recession, a big meltdown, that's when it's likely to happen based on historical data, which does not predict the future, but does give us some interesting indications of how things could play out. Charlie Bolelo here saying the Fed's current projection for the Fed fund rate, 5.6%, aka one more hike by the end of the year. Then end of 2024, 5.1%. That means the Federal Reserve's current projections are going to have one more hike. Maybe it's November, maybe it's December. Set a 12-month clock. And then fast forward a year, they're going to do their first rate hike cut. When that first cut happens, it's probably the time to get the heck out of everything and move into cash or avoid, in order to try and time the market and get out before we see a 50% crash in equities. Will that happen? Will things play out like that? Nobody knows, but that's what happened in 2008. End of 25, they look at a 3.9% Federal Reserve interest rate, fund rate. Will that be correct? Who knows? 2025 is a long time away. But again, we're in the higher for longer narrative right now, so be careful. Also, there's other things you can bring in here. For example, banks are rapidly tightening their lending standards. We covered that the other day in a video. The Fed plans to hold rates higher for longer, thus the risk of a credit crunch is extremely elevated. So that's something to keep an eye out for. Now, can that go higher? Yes. Can that predict a recession for us? Not necessarily, but it does certainly align with recessionary conditions, either coming soon or coming in maybe a bit longer, but underway regardless. You see, anytime there's been these huge spikes, or most of the time when there's been these huge spikes like this, it's resulted in a recession or met with a recession or come just after a recession, as in 2020. Kabizi pointing out higher spending on gas often precedes recessions. Rising interest payments are already eroding disposable income in the USA. Currently, U.S. personal interest payments are rising in a straight line higher, and gas prices are nearing $4. If the Fed manages to avoid a recession, it would make history. Crazy stuff, guys. This would be the largest move higher in U.S. personal interest expense since 1960 without a recession. If the Fed, it's almost like a miracle at this point if the Fed truly pulls off their soft landing. Now, is this predictive for us? Can this tell us, well, with these gas prices going up, when does that meet up with a recession? U.S. personal, can this help us try to determine when that happens? Not necessarily. I think the best possible indicator we have is the lag effect and the relationship between those higher interest rates and when it really, truly causes a major economic slowdown. Now, Jerome Powell still out here saying, well, the soft landing is not the baseline case anymore, but it's in the forecast. What? That's problematic. Federal Reserve also saying they don't see a recession until at least 2027. Okay, guys, you got to decide what you want to do here. Look, recession will come at some point in the United States. Is it going to come sooner or is it going to come later? That's the only question. Recessions are a natural part of market cycles. You need to get used to them happening. Don't fear them as if everything's going to fall apart and your life's going to be over and all stuff, but you have to be ready because they are storms, and they are storms that can blow your house over economically, financially, if you're not ready. So you have to be prepared. You have to have cash on hand, of course, in case you lose your job and all that sort of stuff. You have to be wary of how it's going to affect your investments. Ideally, you're going to have a second or third or fourth source of cash income so that you're able to weather the worst of any storm that comes your way. And that's just a rule for life, to be honest. But if the baseline case is not a soft landing anymore, that's a big statement from the Fed, because that means that their baseline case has changed to potentially a hard landing. And while they're still hoping for a soft landing, there's too many indicators pointing towards that may be a fantasy at this point. But hey, they say maybe it's going to be till 2027. I think that's overly optimistic. Unless they just keep raising interest rates forever. I guess we'll see. Anyway, knowledge is power. I hope you found this video interesting and useful. Obviously, if you have, leave a comment down below and let me know what you think of it. Okay, that's it. I'll see you next time.